Hey everyone, my name is Michael, and today we're going to cover common financial analyst interview questions that my friends and I have encountered while interviewing at these companies. We'll be covering a total of 5 interview questions from easy to hard, plus 1 bonus interview question at the end of the video. Alright, let's start with question number 1, which is an actual interview question that I received in a first round interview with an investment bank. Say you could receive $10,000 today or $10,000 2 years into the future. At what discount rate would you choose to receive $10,000 2 years into the future? So this is actually sort of a trick question because unless you somehow manage to get a negative discount rate, any positive discount rate would reduce the present value of your future 10K amount, so you'd pretty much always end up going with $10,000 today. There's really not much of a thinking process to show for this type of question, as it's really just a quick test of the fundamental finance concept, the time value of money. Simply put, the time value of money basically means that $1 today is going to be worth more than $1 tomorrow. And this makes sense, right? Because if you receive $10,000 today, you could invest that money and get $10,100 maybe a year from now. But if you receive $10,000 a year from now, you would miss out on that extra $100. All right, now let's try question number 2. How can a company with positive EBITDA end up with negative net income? So this question is basically going to test your understanding of EBITDA and the flow of an income statement. First, you need to understand that EBITDA stands for earnings before interest, taxes, depreciation, and amortization. With this in mind, if you understand the flow structure of an income statement and you know that the company has positive EBITDA, you can guess that net income can only be negative from interest, taxes, depreciation, and amortization. From these options, let's rule out taxes and just assume that companies only pay tax on positive pre-tax income. Then we can explain to the interviewer that net income can then only be negative from 2 things. 1, the company has a lot of debt on its balance sheet, and the interest expense on its debt is sucking out a lot of cash from the company. Or 2, the company has a lot of PP&E, so property, plant, and equipment, or even some intellectual property, and these assets are on some kind of, let's say, accelerated depreciation schedule that's generating a lot of high depreciation and amortization expense, which is driving down earnings. Now let's try question number 3. What are some ratios that you would use to measure the health and risk of a company? So this question is designed to test your knowledge of financial ratios, and there are tons and tons of different ratios out there, but as long as you can name a few, you should be okay. Here are some example ratios that you could cover. You have the current ratio, which simply takes a company's current assets and divides it by its current liabilities. With this ratio, you'll pretty much want to explain how a company with a low current ratio could be at risk of not being able to pay their short-term liabilities with their short-term assets, and if this goes on for too long, the company could be in danger of going bankrupt. Then you have the quick ratio, which is very similar to the current ratio, except you exclude inventory and prepaid expenses from your current assets. This basically makes the ratio more accurate because in reality, inventory might not be so easy to convert back into cash quickly to cover your short-term liabilities, and with prepaid expenses, well, who knows if you can actually convert that back to cash. Operating margin can be interesting because you basically take the company's operating income and divide it by the company's revenue. This can be a great way for you to evaluate a company's core business model and its profitability because it allows you to see what a company is able to keep after its operating expenses. A strong operating margin can indicate a healthy business, and it's a bit more of an honest metric relative to net income, where companies can do a lot of funny business when manipulating things like interest, taxes, depreciation, and amortization, which can show some misleading net income figures. Okay, now question number 4. What are some different methods that you could use to value a company? If you get asked this question, you'll probably want to mention the 3 core valuation methods, which are the discounted cash flow analysis, comparable companies analysis, and precedent transactions analysis. The discounted cash flow analysis, also known as a DCF, is a form of intrinsic valuation where the main idea is to basically forecast all of the company's future cash flows and then discount those cash flows to the present value to find the current valuation of the company. The DCF is considered a form of intrinsic valuation because it mostly uses the company's internal financial figures as opposed to any external market values or comparable figures. Then you have comps, or the comparable companies analysis, which is an extrinsic valuation method that basically uses ratios or multiples to value a company. The idea idea here is to basically gather a pool of comparable or similar companies and then find the median valuation ratio, for example, EV to EBITDA, and then apply that median valuation ratio to your target company. Since this method uses external company figures, it's considered an extrinsic valuation method. Then you have the precedent transactions analysis, which is actually quite similar to the comparable companies analysis, except this method uses actual acquisition deals to value a company. The idea here is that you basically want to look for similar companies that have been acquired or bought out, then assume that your target company would be valued at a similar multiple if it were to be acquired or bought by some other company in today's market. Okay, now let's try question number 5. Should the weighted average cost of capital be higher for a company with a $100 million market cap or a $100 billion market cap, assuming all other things equal? So this question is actually pretty simple, as long as you understand that the weighted average cost of capital, or WACC, really represents the risk of a company. So in other words, a company with a low WACC is less risky, and a company with a high WACC is more risky. Given what we know about the two companies, we can assume that the $100 billion company is much larger, more consistent, and more stable, and so is therefore less risky. With this in mind, we should say that the $100 million company is a bit more risky and should therefore have the higher weighted average cost of capital. All right, now we're ready for our bonus question. In these financial analyst interviews, you'll sometimes encounter these brain teaser or market sizing questions designed to test your thinking process, as well as how you can handle these complex and creative scenarios. In this bonus question, we'll cover this real example, which is how many cups of coffee do you think Starbucks sells in the US each day? When you first hear this type of question, it'll be good for you to ask the interviewer some more follow-up questions to help refine your calculation. So for example, with this coffee question, you could ask, are you talking about just in-store coffee sales, or are you also including those pre-made coffee cups that they sell online or in grocery stores for those at-home coffee machines? In this example, let's say that they're happy with just the in-store coffee sales. Now to break this down, we're gonna have to use a few assumptions. First, let's assume that the US population is around 300 million people. Next, let's assume that only adults drink coffee, and so let's say that about 75% of the population is above 18, and that gives us about 225 million people. Then following that, we know that not all adults drink coffee, so let's just say that from personal experience, maybe 3 out of every 4 friends drink coffee, or about 75%. So that leaves us with roughly 160 million people. And then we have to make another assumption because not everyone actually goes out to buy coffee. Let's say that some Americans, or 50% of Americans, will stay home and make their coffee at home, and then another 25% will go to work and use the office machines. So that leaves us about 25% who will actually go out to a store to buy coffee, and that gives us around 40 million people. Then let's assume that the coffee competition is really tough with McDonald's, Dunkin', and all these other smaller mom and pop brands. So let's say that Starbucks is able to hold about 10% of that market, which is roughly 4 million people. Then finally, we know that some people drink multiple cups of coffee each day, while others might only drink it on the weekend. So let's assume that that averages out to about 1 cup of coffee per person per day. And so if we multiply 4 million people by 1 cup of coffee per person, we get 4 million cups of Starbucks coffee being sold in the US each day. Okay, so this answer might not be correct, or even really close to the correct answer, but at least it showed how we could structure our thought process to come up with an answer. So that's our video on common financial analyst interview questions. If you're still currently preparing for your financial analyst applications, consider checking out this video here. And as always, if you found this video useful, please give us a like and subscribe, and stay tuned for more videos.